Hi, it's Jack here at System Trader, and in this very short video I'm going to tell you about the factor ETFs. What's this all about? This is the very introductory video, and in the subsequent videos I'm going to touch more practical aspects. So let's get started. What is the history of factor ETFs? And I think that it's very helpful to go back and see how the history looks, because then we can better understand how all this happened. So basically, as we can see on this picture, which I took from MSCI website, is that actually up to the 60s, there was nothing like factor investing, and there was nothing like alpha. Everyone was just investing money the way he or she thought is the best. So basically, we were talking about the portfolio return. Obviously, if someone was doing the stock picking and if someone was not using a mutual fund, was obviously doing the stock picking, each investor could have a different result, but it was harder on a theoretical ground to explain what is the source of this return. And then in the 70s, the first index funds were founded by Vanguard, by Jack Bogle, and then we could say about the market return. Obviously, before the 70s, we could, in theory, invest in the following just an index, like, for example, Dow Jones Industrial Average. But that wasn't that easy, because the investor would have to have sufficient capital and would have to put all the stocks in the portfolio and then follow the weights, what was not that easy. But once the index funds were introduced, all that was much easier for the investors, just to get the market return. And the market here we can see as the simple capital weighted, cap weighted index, like, for example, I mentioned before, a Dow Jones Industrial Average or S&P 500 or any other cap weighted index. And if someone was able to generate, to get the bigger return than the market return, then we were actually then saying that someone is first actively investing, and then second is delivering alpha, is just performing better than the market. And actually, the index funds were becoming more and more popular, and in the 90s, the first ETFs were introduced, which were in fact a better way, or more accessible way to invest in the index, because we could just do it directly on the market, just buying or selling ETF like stock. But in 2000, and around 20 years ago, we were trying to get more understanding how all this works when someone is performing better than the market. And obviously it wasn't that 20 years ago it was all discovered, but because some theory was already documented in the 70s, 80s, and so on. But then we could say that, for example, the market return is coming from a certain characteristics of the stock portfolio, and these were called factor return. And then we could say that we have factor investing, and ETF could just, instead of following a simple index based on capitalization, just could follow a different index which is constructed around factors. But we'll get to that sooner into more details. And obviously, still we had the alpha investing, active investing. So if someone was able to produce more return above the market return, we could say that someone has the alpha. And the popularization of factor ETFs happened after the crash of the market, 2007, 2009. And the reason for that was simple. No one wants to be average investor. And if someone was just investing in the index fund or ETF following index fund, some simple index, then we had the average of the market, and the returns were also average. And obviously, after 2007 and 2009, these returns were very poor because the market crashed. So that was a good moment, at least from the ETFs providers' point of view, to introduce more ETFs which were constructed not only based on simple indexes, but also based on indexes which are constructed around factors. But what is this classic approach, this index fund, the ETFs which are following simple indexes? So here we can see simple capitalization weighted index, S&P 500. And as we can see, although there are 500 stocks in that index, we can see that the top 10, the very biggest 10 companies from that index, these companies weigh over 26%. In other words, we can see that the bigger company is, the higher capitalization of a company is, the bigger it has the share in the index. So we can see, for example, Apple, which is having over 5% in the S&P 500, although which is a lot if we consider that there are 500 companies in S&P 500. So it doesn't mean that if you buy S&P 500 that you have 500 companies which are equally distributed in that index. But in fact, as you can see, 26% of that index is based on 10 top biggest companies. And that's not always the best approach. Nobody wants to be average, as I said before. And therefore, because the market was going down in 2007 and 2009, the factor ETFs became more popular. And what are the factors? So let's go from the very beginning. We can look on factors as a set of distinctive features, which explains the source of the return on investment. So we are not only blindly picking stocks which we think will grow better or whatever, they will have less volatility. We are just measuring distinctive features, and based on these features, we are building factors. And some example which is not related to the financial market. Let's say that a number of factors can affect your home valuation. And if you think, in fact, about your home valuation, really, indeed, you'll see that a number of factors can affect that valuation. Because if we have 5 or 7 or 10 or 3 rooms, it may have an impact on the valuation of our home. The same is about the living space, the neighborhood, and we could provide here more factors which affect our home valuation. And this is very similar in the financial world. But there we don't have, obviously, rooms, we don't have neighborhood, but we have different metrics which can affect the valuation of the stock. And as I said, traditionally indices are weighted by capitalization, market capitalization. So if the bigger company is, the company is having a bigger share in that index. Factor indices, on the other hand, are weighted by other criteria, not by the capitalization. And here we can see a nice picture from MSCI, which shows us basically two approaches to investing: the active management, what we knew before the era of the index investing, and then we see also the passive investing. So once the index funds were introduced, we could just passively invest in the market and just capture the market return. However, in between, there is something like factor indexes. So in fact, they are not really passive, because now we can have a different set of features which are telling us what stocks we should have in the index. And it's not only capitalization. On the other hand, it's passive, because if we have such index and we buy ETF, then basically from the investor point of view, this investment is passive, because we just can buy and hold such factor index. Although behind the scene, it's not very passive, and in fact, it's a rule-based approach to investing, which seems to be passive from the investor point of view. And what are these factors which can be helpful for us to construct different indexes, not based only on capitalization? And here are 6 factors which are mentioned, and which I will talk about a bit later soon and in the next videos. So we have a value factor, we have size, momentum, quality, low volatility, and high yield. And I will discuss a bit more on these factors soon, but now I would like to mention about the smart beta. The smart beta, because we can sometimes see that ETFs which are based on the factor indexes are called smart beta ETFs. And it's just the pure marketing name for factors. In fact, even Eugene Fama said that it's a marketing ploy, that they are called smart beta, because there is no such thing as smart beta. If we have smart beta, then that would mean that we have dumb beta and or whatever else. I mean, there is beta or there is no beta. There may be alpha, but there is no such thing as smart beta. But just to distinguish from the marketing point of view that there is a better passive approach to investing, they called it smart. And in fact, behind the scene, as I said already, we have a rule-based strategies, and Morningstar calls them even strategic beta. And as we know already, they are widely used by ETFs. So now I will just go further and discuss very shortly about each factor. I mean, factors, I cannot cover all of them because there are hundreds of factors, in fact. But there are, let's say, the major factors, and we can have 3, 4, 5, up to 6 major factors, which should be sufficient for most of the investors. And the first factor I would like to mention here is the size. And what is the size? It was first documented by Mr. Barnes in 1981, and he just found that the stocks with small market capitalization tended to outperform stocks with large market capitalizations. So it happens that if rather than buying large companies, we buy stock which are from the small with the small market capitalizations, then basically we have a chance to get a better return. A small cap stock is a company, by the way, in United States with a market capitalization of less than $2 billion. But there is a price to pay for that, for the fact that we want to get to capture a better return, because the small cap stocks, there are basically we can say more volatile than big cap stocks, and also the trading costs may be higher, which makes sense because if the stock is not that liquid, it may happen that we have to pay more on the trading cost side. Another factor is value, and it was first documented by Mr. Basu in 1983, although the whole concept about the value investing was popularized already in the 30s of the previous century, 20th century, by well-known Benjamin Graham and David Dodd. And basically, we can say that the whole idea about the value investing is about looking for fundamentally cheap companies. And it even happens that if we buy a cheap company and this company is small cap company, or so-called small cap value company, it even performed historically better than the large value companies. And how to measure the value of a company? For that, we can use a lot of metrics. And here are three examples: price to book, price to earnings, or forward price to earnings. Another factor, momentum, first documented by Jagadish and Titman in 1993, although again it has been used by many investors before, although not so theoretically described and documented. But basically we can say that the whole idea about momentum is that the stocks tend to maintain recent price trends in the future. So basically the momentum strategy takes advantage of this phenomenon. And Eugene Fama, which I mentioned before, the Nobel Prize winner, he said that momentum, among other factors, is the premier market anomaly. The problem with the momentum on the individual stocks is that it can generate high transaction costs. It's a high turnover strategy, which can cause us that, although on the paper the strategy looks very optimistic, when we just consider the transaction costs, it may not look so great. There are other solutions for that, for example, using the momentum on the indexes, but that's for another occasion in another video. Another factor, quality. And what is the quality? And here is the great quote from Barron's, that quality is the stuff I own and crap is the stuff I don't own. The problem with quality is that there is no clear definition. And companies with durable business models and sustainable competitive advantages, or high margins, or low debt, or high quality of management, we can say that these companies are of high quality. But everyone can implement this in a different way, so there is no really clear definition for that. Low volatility. Companies with lower volatility and lower correlation with other companies, we say that these companies are based on the factor called just low volatility. And this factor is considered as a defensive factor. So its purpose is not to maximize profit, but to just minimize volatility, or in other words, the risk. That's all for today, for now. In the next video, I will tell you more about practical aspects, because although the factor looks quite often very great on the paper, there are traps which you have to consider before investing. Thank you very much for your attention. Bye-bye.